study with me. Come study with me. We open the books and we keep our feet steady.
Alright, welcome back. Today is Wednesday.
Let's work on our
Let's
dreams.
go ahead and go through the
One
class.
page at a time till the whole
Alright, welcome. If you're here today, let's get to work.
May he give you wisdom.
Alright, so go back. Right, so we keep studying what is it again? Rest my brain just a moment. Okay. INACO had the following beginning and ending balances in its prepaid, expense and accrued liabilities accounts for the current year. Before I do that, let me do this. Let me do something else, because this I want to clip it. Cash to accrual conversion class. Cash to accrual conversion class. Before we convert anything, what is the first question we ask? The question is, what are we converting? Revenue, expense, or net income? What are we converting? Revenue, expense, or net income? Excellent. Why is that important? Because the same adjustment can have a different effect on revenue, expense, and net income. What is the net income formula? What is the net income formula? Income equals revenue minus expense. Income equals revenue minus expense. If revenue goes up, what happens to income? Income goes up. If revenue goes down, what happens to income? Income goes down. Therefore, revenue and income move in what direction? The same direction. Say it again. Revenue adjustments affect income in the same direction. If I add to revenue, what do I do to income? Add to income. If I subtract from revenue, what do I do to income? Subtract to income. Excellent. Now let's talk about expense. If expense goes up, what happens to income? Income goes down. If expense goes down, what happens to income? Income goes up. Therefore, expenses and income move in what direction? Opposite directions. Say it again. expense adjustments affect income in the opposite direction? If I add to expense, what do I do to income? Subtract from income. If I subtract from expense, what do I do to income? Add to income. What are the main revenue accounts? Accounts receivable and unearned revenue. Say it again. Accounts receivable and unearned revenue. Say it again. Accounts receivable and unearned revenue. If accounts receivable increases, what do I do to revenue? Add to revenue. And because revenue and income move together, add to income. If accounts receivable decreases, what do I do to revenue? Subtract from revenue. Subtract from income. If unearned revenue increases, subtract from revenue, subtract from income. Again, if unearned revenue increases, subtract from revenue, subtract from income. If unearned revenue decreases, add to revenue, add to income. Again, if unearned revenue decreases, add to revenue, add to income. What are the main expense accounts? Accounts payable, accrued expenses, and prepaid expenses. If accounts payable increases, add to expense. Again, if accounts payable increases, add to expense. And because expense and income move opposite, what should I do to income? Subtract from income. Subtract from income. If accounts payable decreases, what do I do to expense? Subtract from expense. If accounts payable decreases, subtract from expense. If accounts payable decreases, subtract to expense. If accounts payable decreases, subtract from expense. And because expense and income move opposite, add to income. And because expense and income move opposite, add to income. If accounts payable decreases, add to income. If accounts payable decreases, add to income. Why? Because you subtract from expense. If accounts payable decreases, add to income. Why? Because you subtract from expense. Because you subtract from expense. Because you subtract from expense. If accounts payable decreases, subtract from expense, add to income. If accrued expenses increase, add to expense. If accrued expenses increase, add to expense. If accrued expenses increase, add to expense. Subtract from income. Add to expense, subtract from income. If accrued expenses increase, if accrued expenses increase, if accrued expenses increase, add to income, add to expense, subtract from income. If accrued expenses decrease, if accrued expenses decrease, if accrued expenses decrease, subtract from expense, add to income. If accrued expenses decrease, if accrued expenses decrease, subtract from expense, add to income. If prepaid expenses increase, if prepaid expenses increase, subtract from expense, add to income. If prepaid expenses increase, subtract from expense, add to income. If prepaid expenses increase, subtract from expense, add to income. If prepaid expenses increase, subtract from expense, add to income. If prepaid expenses decrease, add to expense, subtract from income. If prepaid expenses decrease, add to expense, subtract from income. If prepaid expenses decrease, add to expense, subtract from income. The golden rule. Revenue adjustments affect income in what direction? The same direction. Expense adjustments affect income in what direction? The opposite direction. When confused, what formula do we return to? Income equals revenue minus expense. Income equals revenue minus expense. Income equals revenue minus expense. One more time. Revenue moves with income. Expense moves opposite to income. Income equals revenue minus expense. Excellent. We got it. So this is for me to clip it. Because this, we need to dominate this. We cannot let this slip like that. We need to dominate it. We're going to do everything possible to dominate it. All right, so let's keep going with our class today. Okay. Give me just a second. All right, let's get to work. Okay, INACO had the following beginning and ending balances in its prepaid expense and accrued liabilities accounts for the current year. Okay. Prepaid expense, beginning balance $5,000, ending balance $10,000. Accounts payable, beginning balance $8,000, ending balance $20,000. So here we have prepaid expense increased $5,000 from $5,000 to $10,000. Accounts payable increased from $8,000 to $20,000, so that's $12,000. Debits to operating expenses totaled $100,000. What amount did INA pay for operating expenses during the current year? So what happened? Prepaid expense had the following beginning and ending balances in its prepaid expense and accrued liabilities account. So this is not cash, this is accrual. Debits to operating expenses totaled $100,000. So prepaid expense increased $5,000. Our prepaid expense increased $5,000. If prepaid expense increased, what do we do? All right, so remember the lesson. Let me go to this. Prepaid expense. What is prepaid expense? Prepaid expense is when you pay for something in advance. Let's say you pay for insurance. You have an insurance policy for 3 years and you pay for the whole 3 years in advance. This is a prepaid expense. This is prepaid expense. So what happens when there is a how does accrual report prepaid expense? So if you make a payment today for a service that you're going to be using next year, accrual does not recognize that payment because you have not used the service yet. So accrual will not report that as an expense. Accrual will not report that as an expense because you have not used the service. It's not accrued. So that $5,000 in beginning in prepaid expense need to be subtracted from expenses. $5,000. So here we're gonna have 95,000. What about accounts payable? Accounts payable increased $12,000. Accounts payable increased $12,000. I need to understand that. Let me see. This is the most confusing thing I have seen. It is the simplest thing, but the most confusing one. That means if one does not dominate this to the core, you will struggle. It is simple. It is simple thing. For me, that's the easiest class, but that's the most complicated one. That's the easiest one and the most complicated one too. I've been studying this for 2 days. Okay. This is perfect example why prepaid expenses and accounts payable behave differently. What are we given? Operating expense accrued basis. Accrual basis 100,000. Change. Account prepaid expense $5,000. Accounts payable $8,000 beginning, ending 20,000. So we already have the numbers. The question asks how much cash was actually paid. So we are converting accrual expense to cash. To cash paid. Okay. So accrual to cash. Now I need to understand that Inerco had the following beginning and ending balances in its prepaid expense and accrued liabilities accounts for the current year. Okay, debits to operating expenses total 100,000. What amount did INA pay for operating expenses during the current year? So I need to understand why we're doing from accrual to cash. What is the key word? But before we do that, I know it's from accrual to cash. I need to be able to do that from my mind. So it's going to be the inverse in this case. Beginning balance of prepaid expense. So how does prepaid expense work in cash? In cash basis, prepaid expense, today you make the payment today. Let's say I make a $5,000 payment today for a service I'm going to be using next year. Accrual does not recognize that payment because I have not used the service. Cash, since I have paid the money, the cash went out of my account. Cash is recognizing that payment today. Cash is saying that we made a $5,000 payment today, a $5,000 payment today. Therefore, we need to recognize that payment. So for cash, we need to add $5,000. Add $5,000 on that 100,000, so it's going to be $105,000. We have accounts payable. Accounts payable increased from $8,000 to $20,000, so that's $12,000. What do we do with that? So what is accounts payable? Accounts payable is money that I owe other people, right? So I owe an extra $12,000 at the end of the year. So I owe $12,000. What does that mean? It means that this is money that I had to pay that I did not pay. That's money that did not leave my account. So since that money didn't leave my account, cash is saying that I didn't make any payment. But accrual is saying that that payment has been accrued, so we are paying it. So we are reporting it as an expense. But cash is saying we're not reporting that as an expense because we have not made the payment. Okay? Cash is saying that we have not made the payment, so we are not recognizing that as a payment. So what we're going to do, we will add 12,000. Wait. Accounts payable. Cash is saying that we are not recognizing that $12,000 expense. So we need to subtract $12,000 from 105. Yeah. Because we're converting to cash. 105 minus $12,000. That makes it $93,000, and that's correct. Okay. So my follow-up question is to get the keywords. What keywords should I pay attention to understand that which account I am converting from or which account I am converting to? In this question, we are converting from accrual to cash. What makes me understand that we are converting from accrual to cash in this case or in any other case? What are the keywords? Yeah, this is very important. Because if we don't understand what we're doing, we may do the inverse and we lose it. Not because we don't understand the math, but we didn't know exactly what we were doing. Okay. This is one of the most important CPA skills. Before you do any math, identify your starting point and your destination. The keywords in the question tell you both. Find the starting point. What number did they give me? In this question, debits to operating expenses totaled $100,000. Operating expense is an accrual basis expense. Operating expense is an accrual basis expense. So your starting point is accrual expense is $100,000. Step to find the destination. Ask, what number are they asking me to find? The question asks, what amount did I not pay for operating expense? The keyword is pay. Pay equals cash. Okay. Pay equals cash. So the destination is cash paid. Translation table. Question says revenue, starting point, accrual revenue. Question says sales, accrual revenue. Starting point is accrual revenue. Question says expense, starting point accrual expense. Question says operating expense, starting point accrual expense. Question says net income, starting point is accrual net income. Question asks cash received, destination cash. Question asks collected, destination cash. Question asks cash collections, destination cash. Question asks paid, destination cash. Question asks cash paid, destination cash. Question asks disbursed, destination cash. In this question, we are given operating expenses, $100,000. Operating expenses, starting point, accrued expense. Asked, how much did Ina pay? Destination, cash paid. Therefore, accrual to cash. Another example, suppose they say, cash paid to suppliers was $80,000. What amount of expense should be reported? Given cash paid, this is they give you cash basis. They ask you expense reported, accrual. Now you're going cash to accrual. Okay, so CPA exam trigger words. Accrual to cash. Look for cash received, cash collected, cash collections, cash paid, cash disbursement or disbursements, amount paid. Example, revenue was $100,000. How much cash was collected? This is revenue equals accrual. Collected equals cash. Therefore, we're doing accrual to cash. Cash to accrual. Look for revenue recognized. Revenue reported. Expense recognized. Expense reported. Net income. Income reported. Example, cash collections were $100,000. What revenue should be recognized? Collections to cash. Revenue recognized equals accrual. Therefore, cash to accrual. I don't get it. Revenue to cash. Cash collections were $100,000. What revenue should be recognized? So that should be cash to accrual. Yes, cash to accrual. That's right. Okay. The one question I ask every time before solving, ask, am I starting with an income statement number or cash number? Right? If you're starting with revenue, expense, net income, you're starting with accrual. If you're starting with cash received, cash collected, cash paid, you're starting with cash. Then ask, what are they asking me to find? Whatever they ask for is your destination. Your CPA mantra, revenue, expense, net income, accrual, collected, received, paid, disbursed, cash. Then determine accrual to cash or cash to accrual. Okay, that's good. Your CPA mantra, revenue, expense, net income, accrual, collected, received, paid, disbursed, collected, received, paid, and disbursed, cash. Revenue, expense, and net income, accrual, collected, received, and paid, collected, received, paid, and disbursed, cash. All right, so that's good. I need that. Okay. Next. Let's go next question. Okay. So what's the next one? Class Corp maintains its accounting records on the cash basis but restates its financial statements to the accrual method of accounting. So here we already know it's from cash to accrual. Class had $60,000 in cash basis pre-tax income for year 2. The following information pertains to class's operations for the year ended December 31st, year 2 and year 1. Pay attention. Year accounts receivable, year 2, $40,000, year 1, $20,000. Accounts payable, year 2, $15,000, year 1, $30,000. Under the accrual method, what amount of income before taxes should class report in its December 31st, year 2 income statement? Okay. So accounts receivable increased from $20,000 year 1 to $40,000 year 2. That's $20,000. Let's work with that first. What is our starting point? Our starting point is, just a moment. I saw something here. Class maintains account records, cash basis, but restate. All right, class had $60,000 in cash basis pre-tax. So cash was reporting $60,000. How much should we report under accrual? Okay, let's work with accounts receivable first. What is accounts receivable? Accounts receivable is when you sell things on credit. You sell things on credit, customers owe you money. They haven't paid you yet. Cash, when you sell something on credit, cash complains because no cash came in. Cash says, I didn't make any money. In this case, there is a $20,000 credit. Cash is complaining. Cash is saying, I didn't make any money and I'm not going to report anything. That $20,000, cash did not report it because cash says, I didn't get that money. So that $20,000 need to be reported under accrual. So in this case, we will add $20,000 to $60,000. All right, so that's going to make it what, 80,000? Yes, that's going to be $80,000. Okay, so that's going to be $80,000. Let's go with accounts payable. What is accounts payable? Accounts payable is when you owe people money. The money you owe people, right? So there's money that you need to pay to other people. What happens? There is a decrease in accounts payable from $30,000 year 1 to $15,000 year 2. When accounts payable decrease, what is happening? What's happening is that it's money that I take from my income to pay to other people, to people that I owe. But guess what happens? Because it is accounts payable, the payment you're making today does not belong to today's transactions. Make sense? The payment I'm making today, the $15,000 that I'm paying today, does not belong to today's transactions. It belongs to past transactions, money that I owe, that I'm paying with money that I have today. So under cash, cash is saying, man, I'm paying $15,000 today because cash is going out. Cash is not happy because cash is going out and cash is reporting $15,000 that cash says I'm paying $15,000 today. But accrual is saying, no. You're not paying $15,000 today because that money you're paying today belongs to transaction that happens last year. Therefore, last year, I have already reported that money. I have already reported that money last year. So the money that you paid this year belongs to money that I have already reported last year. So we are not reporting that again. So what's going to happen? By not reporting that expense, we need to subtract $15,000 from expense. And if we subtract $15 from expense, we need to add $15,000 to income. We need to add $15,000 to income. So that's why here, the amount that they gave us is not expense. Class had $60,000 in cash. Basis pre-tax income. They didn't give us the expense. So if we were working with expense, if the $60,000 was expense, we would need to subtract $15,000 from that $60,000. But the $60,000 is income. That's why we need to add the subtraction to income. Does that make sense? I'm understanding that. So we need to add whatever was subtracted from expense, we need to add it to income. So that $15,000 we subtracted from expense. Why did we subtract that's $15,000 from expense? Because it's not an expense today under accrual. Under accrual, this is not an expense today. This is something that we have already expensed last year. So whatever you pay today, we cannot report it again. We can't report it again. So if you report $15,000 of expense today, that's going to make your income go lower. And we can't do that because that money does not belong to today. So because it made your income go lower, what we're going to do, we will subtract it from your expenses. We will add it to your income. I got it. I'm a teacher. I'm a teacher now. What? Yes. So that's why we're going to add $15,000 to $80,000. It's going to be $95,000. And let me see. It's going to be $95,000. And that's correct. This is correct. Okay. Let's go. See what we got. Dan & Co. mistakenly reported its expenses of $35,200 on the cash basis. So here we're starting with cash. Corporate records revealed the following information. Beginning prepaid expense, $1,300. Beginning accrued expense, $1,650. Ending prepaid expense, $1,800. Ending accrued expense, $1,200. So what amount of expense should the Dannon report on its books under the accrual basis? So this is cash to accrual. What happens with cash? Cash reported expense, not income. Remember, this is so important. And I'm talking to myself for me to remember that. Cash reported expense, not income, of $35,000. Expense. So let's work with beginning prepaid expense. Prepaid expense beginning $1,300. Ending prepaid expense $1,800. So there is a $500 difference here. There is a $500. What do we do with that $500? Do we add? Do we subtract? Okay. What is prepaid expense? Prepaid expense is money that I paid today for service I'm gonna be using next year. Okay, that's prepaid. Money that I paid today, in this case it's $500. I paid that $500 today for service I'm gonna be using next year. What does cash say? Cash says that I am paying $500 today. Therefore, I am going to report that $500 as an expense. Accrual say, hey, that $500 that you're paying, it's a service that you're going to be using next year. Therefore, that $500 needs to be reported next year when you use the service. If you have not used the service, that $500 is an asset. You cannot report it as an expense. But cash has already reported that $500, so that's why we need to subtract that $500 from expense, from cash expense. So it was $35,200. Subtract $500, so it's $34,700. Okay, this is prepaid expense. Let's go with accrued expense. What is accrued expense? Accrued expense is a service that you received today. You received the service today, but you did not pay for it today. You're gonna be paying for it next year. You received the service today, but you haven't paid for it. So cash, what does cash say? Cash say, we didn't pay anything today. Cash is happy because cash remains in the bank account. Cash is happy. Cash say, man, we didn't pay anything today. So first of all, let's go ahead and calculate how much that is. Beginning accrued expense, $1,650. Ending accrued expense, $1,200. So what happens? There is a decrease. There is a decrease in accrued expense. A decrease of $450. If accrued expense decrease, what does that mean? Accrued expense decrease. Okay, accrued expense, what it is, it's a service that I use today, but I'm gonna make the payment next year. It's $450. But it's a decrease. If it's a decrease, that means I have paid that $450. Okay, it's a decrease. From $1,650 to $1,200, that's $450 decrease. Not increase, but decrease. So accrued expense is service that I use today to pay next year. I use the service under cash. Under cash, it says that, listen, we didn't pay anything. Under accrued, it says we have accrued that, we need to report it. But now it's not an increase, but it's a decrease. Accrued expenses decreased. If it decreased, what do I do? Okay, wait. Decrease accrued expense. That means it's money that I have to pay that I paid. I actually paid. I paid the money under cash. So if I paid that $450 under cash, and I say, well, I decreased my accrued expenses, I paid the money, so I'm going to report that as an expense. I'm going to report that as an expense. But guess what? Accrual is saying, no, you cannot report that as an expense. The reason it's because that payment you make today is service that you have already used last year. a service you used last year. So last year we have already reported that as an accrued expense. So you cannot report that $450 that you paid today to lower your accrued expenses. So we can't report that. So that's why, but cash has already reported it in the $35,200. So what do? We need to subtract $450. Okay, 34,700 minus $450, that's 34,250. And this is correct. This is correct. Okay, I think we're getting there. We're getting there. Okay, let me fix the lighting. Okay, let's get to work. All right, let's get to work. Let's get to work. Where you going? Okay. Which of the following statements would most likely be included amongst a set of financial statements prepared or prepared in conformity with a special purpose framework? This answer is the statement of cash receipts and disbursements. The statement of cash receipts and disbursements. What is the question? The question says which of the following statements would most likely be included among a set of financial statements prepared in conformity with a special purpose framework? The answer is the statement of cash receipts and disbursements. And let's go to the explanation for this. In general, financial statements are prepared in accordance with GAAP. However, under certain conditions, financial statements may be prepared in conformity with a comprehensive basis of accounting other than GAAP, referred to as special purpose framework. Special purpose framework statements are designed to provide relevant information to meet the needs of a specific financial statement user and have a limited use for anyone other than the intended user. Examples includes financial statements based on cash receipts and disbursements, income tax regulations, a contractual agreement, an authoritative regulatory agency. Because of the uniqueness of special purpose framework, because of the uniqueness of special purpose framework statements, the content, format, and generally the names of the statements differ from GAAP financial statements. For example, when a cash basis special purpose framework is used, one of the financial statements required is the statement of cash receipts and disbursements instead of the income statement. Therefore, this statement would most likely be prepared under a special purpose framework. Cash receipts and disbursement. That's why the answer is cash receipt and disbursement. Under certain conditions, non-GAAP financial statements may be prepared in conformity with a different comprehensive basis of accounting, referred to as a special purpose framework, SPF. SPFs, special purpose frameworks, are designed to meet the need of a specific financial statement user. Special purpose framework examples include cash, income tax, contractual, and regulatory basis. Okay. Compared to its year one cash basis net income, Potomac Coal's year two accrual basis net income increased when it. So we need to complete that. The answer is when it had lower accrued expenses on December 31st, year 2, than on January 1st, year 2. Let me get a sharp explanation for this real quick so that we don't waste our time trying to explain it with my own words. I think I need to put a more vibrant music. This is not a calm study session. Yeah, I'm gonna be using a more vibrant. What's going on to lighting? Let's attack this one with your new framework. What are they comparing? The question says, compared to its year one cash basis, net income, Potomac Coal's year two accrual basis net income increased when it. So we're comparing cash basis income to accrual basis income. And the key phrase is accrual basis net income increased. In other words, which event makes accrual income higher than cash income? The big idea, whenever accrual income is greater than cash income, it usually means revenue recognized but not yet collected or expense not yet paid. Okay. Analyze each choice. A declared cash dividend in year one that is paid in year two. Dividends are not expenses. They affect equity, not income. Wrote off more accounts receivable than credit loss expense. Write-offs don't directly affect current income because the expense was already recognized through the allowance method. This affects the balance sheet, not the cash versus accrued difference. Had lower accrued expense on December 31st, year 2 than on January 1st, year 2. Let's translate. Suppose beginning accrued expense was $20,000, ending accrued expense equals $10,000. Accrued expense decreased by $10,000. What does that mean? It means the company paid off previous accrued expenses. So cash paid is greater than expense recognized. Therefore, cash basis income is lower. Accrued basis income is higher. This is the correct answer. Okay. Accrued expenses decreased. What happened? We paid liabilities from prior periods. Did cash go out? Yes. Did that payment create a new expense this year? No. The expense was recognized earlier. So cash basis records more expense than accrual basis. Yes. Therefore, which income is higher? Accrual income is higher. Okay. We need to do whatever we can to dominate this. All right, Bailey Co. changed their accounting for insurance expense from the cash basis to accrual basis. So that's clear. Okay. In the current year, sorry, in January of the prior year, Bailey recorded insurance expense of $240,000 for the cash purchase of 4-year insurance policy. That's prepaid expense. How should Bailey report the insurance transaction in the current year's financial statements? There is a special explanation for this. I need to get sharp in it, so I'm not going to try and explain it myself. I'm going to try to explain it myself. Okay. All right, so let's go. Let's do it. So what does it say? This question is not really a cash to accrual conversion question. Okay, it's an accounting change question. The key phrase is change their accounting for insurance expense from the cash basis to the accrual basis. When a company changes from cash basis to accrual basis, we must ask, what should the balance sheet and retained earnings look like if accrual accounting had always been used? Step 1. Understand the transaction. In January of the prior year, they paid $240,000 for a 4-year insurance policy. Under cash basis, they immediately expense all $240,000. Journal entry under cash basis. Insurance expense $240,000. Cash $240,000. Okay, step 2. What should accrual accounting have done? A 4-year policy means $240,000 divided by 4, which is $60,000 per year. Each year should recognize only $60,000 of insurance expense. Step 3. Where are we now? The policy stated in the prior year should have recognized $60,000 expense. Remaining periods or remaining prepaid $240,000 minus $60,000 is $180,000. Current year, another year passes, recognized another $60,000. Expense. Remaining prepaid $180,000 minus $60,000 equals $120,000. Step 4. Compare cash basis to accrual basis. Cash basis already expensed $240,000. Okay? In the prior year. Accrual basis says by the end of current year only, $60,000 plus $60,000 equals $120,000 should have been expensed. So they overexpensed. $240,000 minus 120 equals 120. Wait, where does the answer 180,000 retained earnings come from? Because at the beginning of the current year, the books should have contained beginning of year adjustment. Prepaid insurance equals 180,000. Retained earnings equals $180,000. Why? Because last year they should have carried forward the unused 3 years of insurance. The entry needed: at the beginning of the current year, prepaid insurance equals 180,000, retained earnings equals 180,000. This fixes last year's mistake. Then current year expense. Current year consumes 1 year. Insurance expense 60,000, prepaid insurance 60,000, leaving 180,000 minus 60,000, 120,000 in prepaid insurance. Okay. Choice C. Debit insurance expense 60,000, debit prepaid asset 120,000 ending balance, credit retained earnings 180,000. So okay, let me wait. So why do we even have retained earnings mentioned in this answer? I would have never thought that retained earnings would be part of this. That's exactly why this question is tricky. Most students see insurance expense and prepaid insurance and never think about retained earnings. The reason retained earnings appears here is because the mistake happened in a prior year. Whenever you correct a mistake or make an accounting change that affects a prior year, you do not run it through this year's income statement. You adjust retained earnings. Let's walk through it. What actually happened? Last year they paid $240,000 for a 4-year policy. Under cash basis, they recorded insurance expense for $240,000. So cash $240,000. So last year's net income was reduced by $240,000. What should have happened? Only 1 year of insurance was used. So last year's expense should have been $240,000 divided by 4, $60,000, meaning last year's net income should have been reduced by only $60,000. How much was last year's income understated? $180,000. Last year's income was too low by $180,000. Since last year's income closes into retained earnings, that error now lives inside retained earnings. Think of retained earnings as the storage account for all prior year's profits. Okay. Okay. All right, I see where retained earnings is coming from. A company provides the following information: cash receipts from customers. Year 1, $95,000. Year 2, $120,000 from year 1 sales. From year 2 sales, in year 2, we have $200,000. In year 3, we have $75,000. From year 3 sales, we have $50,000 in year 2, $225,000 in year 3. What is the accrual basis revenue for year 2? The question is about year 2. So we need to focus on year 2, and we're working with what? With accrual. What is the accrued base revenue for year 2? Accrued base revenue. So what is accrued? So accrue recognized whenever you use the service, even if you have not made the payment. Okay? So whenever you sell the goods, even if you have not collected the payment. From year 2 sales, in year 2 we have $200,000. In year 3, we have $75,000. So year 2 sales. Sales made in year 2, we only focus on sales made in year 2. The reason, because the transaction happens in year 2. We don't focus on transaction that happens in year 3 or transaction that happens in year 1, even if we collected payment in year 2. We focus on when did the transaction happen. I can teach. I think I'm becoming a teacher of this thing. It was so confusing to me. Okay? So from year 2 sales, $200,000 in year 2, $75,000 in year 3. That's going to be $275,000. The reason is because the transaction happens in year 2. Even though we collect the payment in year 3, we still report it in year 2 because the transaction happens in year 2. Transaction that happens in year 2 is $275,000. Keep going. Okay. Let's see, what time is it? Okay, it's gonna be time for break. All right. Gonna be time for break. So Dexco is a non-public company that began operations on January 1st, year 3. Dex decided to prepare cash basis financial statements on the first day of operations. Dex paid $24,000 upfront for a 2-year lease for office space. Dex also incurred $25,000 in salary expense for the employee in year 3, including $21,000 paid and $4,000 accrued as of December 31st, year 3. During year 3, Dex recorded $50,000 of total sales revenue, which includes $20,000 of sales recorded on credit. What is the company's year 3 cash basis income, loss from operations? This is cash basis income or loss, but we have a lot of information. Dexco is a non-public company that began operations January 1st, year 3. Dex decided to prepare cash basis financial statements. On the first day of operations, Dex paid $24,000 upfront for a 2-year lease for office space. Okay, let's write this down. $24,000 2-year lease. So they're asking for cash basis. Okay, so we have to record the $24,000 upfront 2-year lease. The reason is because it's cash, even if you have not used it, but cash left your account. So $24,000 under cash. Dex also incurred $25,000 in salary expense for its employee in year 3. Incurred, not paid. Okay? Incurred, not paid. $25,000. So if it's incurred, not paid, so that's, we do not record that under cash, because under accrual, yes, but under cash, we will not report that payment because it's not a payment yet. It's incurred $25,000 in year 3. So we still remain with $24,000 cash, including $21,000 paid. Now we're talking. So we have $21,000 paid in salary. We will add $21,000 on this $24,000. It's gonna be what? It's gonna be $45,000, right? 21 plus 24 is 45. So now we have $45,000 cash paid. All right, let's keep going. During year 3, Dex recorded $50,000 of total sales revenue, not cash collected yet, which includes $20,000 of sales recorded on credit. Okay, so $50,000 of revenue, $20,000 in credit. So the rest of the $30,000 should be cash collected. What is the company's? Okay, so if cash collected was $30,000, we're gonna do 45 plus 30. So that's $75,000. 75,000. $75,000 of what? Am I mixing things? Yes, I'm mixing things. I'm mixing income and expense. And we're not supposed to do that. So we need to put income on the side, expense on the side. Okay. On the first day of Dex paid, this is expense. $24,000 expense upfront for 2 years, okay? $24,000 expense. Dex incurred, all right, 24 plus 24 plus 21 is 45. So this is expense. All right, time for break. This is expense. Let's finish with this. This is expense, $45,000 expense. Okay, $45,000 expense. Now we have Dex recorded $50,000 of total sales revenue, which includes $20,000 of sales recorded on credit. Okay, so $30,000 cash came in. So $30,000 cash came in, $45,000 went out. Cash went out. So we're going to do 45 minus 30. That's $15,000 loss. That's a $15,000 loss. Let's see if that's correct. That should be correct. Yes, this is correct. That's good. All right, so let's go on break. We'll come back later.
Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Study with me. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. you can still take a stand, no matter if you wanna be a CPA, MD, or R.
All right, we're back from break. That went quick. Okay, so okay, so yes, so we just finished with let's go back to the last question. Okay, so we got it. We said it was a loss of $15,000. I'm gonna read it again. Dexco is Dexco is a non-public company that began operations on January 1st, year 3. Dex decided to prepare cash basis financial statements. On the first day of operations, Dex paid $24,000 upfront, so that's money going out. For a 2-year lease for the office space. Dex also incurred $25,000 in salary expense. It's incurred, not paid yet, for its employee in year 3, including $21,000 paid. Okay, so now $21,000 plus $24,000 is $45,000 that of cash that went out under cash basis. Okay, so next one, $4,000 accrued as of December 31st, year 3. During year 3, Dex recorded $50,000 of total sales. $50,000 of total sales, not total cash received, which includes $20,000 of sales recorded on credit. $20,000 sales on credit. What does that tells us? It tells us that $30,000 was cash received. So what we did is $45,000 minus $30,000 is $15,000 loss, because $45,000 went out, $30,000 came in. So it's the $15,000 loss. Let's keep going. RICO is a small privately held entity established at the beginning of year 1. Wright decided to prepare cash basis financial statements, cash basis, at the end of year 1. The company recorded receivables of $2 million, in accrued expenses of $900,000. You didn't make no money, which were included in the total expenses incurred for the year of $2,200,000, with $1,300,000 paid during the year. Cash sales of $1,200,000 were fully recognized for the year. What is the company's cash basis income or loss from operations at the end of year 1? So what do we have? Cash basis, we only care about cash. Okay? Not revenue, not sales, whatever. We only worry about cash came in, cash went out. Okay? So what do we have? Wright decided to prepare cash basis financial statements. The company recorded receivables of $2 million. That's receivables. It's not money that they received. That's receivable. That's money people owe them. All right, $2 million in accrued expense. Accrued expense of $900,000. Accrued expense. That's not money that went out already. Also, which were included in the total expenses incurred for the year of $2,200,000. So if we have $2,200,000 of total expenses minus $900,000. 2,200,000 minus 900,000. That's $1,300,000 cash. Because what they trying to tell me here, and all right, wait. The company recorded receivables of $2 million and accrued expenses. Accrued expenses, expenses that you have not paid yet. Okay? Accrued expenses, $900,000, which were included in the total expenses incurred for the year of $2,200,000. So if you incurred $2,200,000 of expenses, you still have $900,000 accrued. So that means you paid the rest. You paid $1,300,000. That's okay. You paid $1,300,000. So that's cash that went out with a $1,300,000 paid during the year. Okay. They just said it again. They just said it. That's good. Okay. Cash sales. Paid, that money went out. $1,300,000 went out. Cash sales of $1,200,000 were fully recognized for the year. Okay, so you have a $1,200,000 cash received, $1,300,000 cash paid. So you have a $100,000 loss. A loss of $100,000. That's correct. A company reports on the cash basis. During the company's first year of business, it had sales on account of $1 million, inventory purchases on account of $400,000, and other expenses of $200,000. At the end of the year, the company had accounts receivable, inventory, and inventory-related accounts payable of $100,000, $10,000, and $50,000 respectively. What is the company's cash basis income for its first year of operation? Okay, we will see what it is. Okay. The question is, what is the company's cash basis income for its first year of operation? Remember, cash only worry about cash comes in, cash goes out. That's the only thing it worries about. If you paid cash, we worry about that. If you receive cash, we're happy about it. Okay? So let's see. During the company's first year of business, it had sales on account of $1 million. $1 million of sales. Inventory purchases on account of $400,000 and other expenses of $200,000. At the end of the year, the company had accounts receivable, inventory, and inventory related accounts payable of $100,000, $10,000, $50,000 respectively. They're trying to trick me here. Trying to trick me. On account, what does it mean on account? I need to know exactly what they mean when they say something is on account. Okay. Is it credit or what? What does it mean when you sell something on account or you purchase something on account? Is it credit? Yes, on account means on credit. Okay. All right. This one of the most important CPA phrases: on account, on credit. Selling on account, selling on credit. Suppose I sell you a laptop for $1,000. You don't pay me today. You promise to pay me later. That's a sell on account. Journal entry: DR accounts receivable 1,000. CR sales revenue 1,000. Meaning revenue recognized today, cash not received yet. Customer owes me money. Okay, so I'm getting it. We'll get in there. My lighting is so off. Let me that real quick. Be right back. Okay. All right, so let's go. Let's do it. All right, let's go back to the question. What does it say? A company reports on a cash basis. Okay, a company reports on a cash basis during the company's first year of business. It had sales on account, credit sales, $1 million, inventory purchases, credit, $400,000, and other expenses of $200,000. Other expenses. Okay. At the end of the year, the company had accounts receivable. That means money that they still owe them. Inventory. That's purchases. Or things they have not sold yet. And inventory related accounts. Payable. Accounts payable. Inventory related accounts payable. That means money they have to pay. Money they have to pay. Receivable, money they need to receive. Inventory is money that is seated in inventory, in goods. Inventory related accounts payable, it's money they need to pay to others. Okay, so let's think about it. $100,000 accounts receivable. If they have $100,000 accounts receivable, they sold for $1 million. That means they collected $900,000. Right? That means they collected $900,000. All right, let's keep that here. The second one had accounts receivable of $100,000. They collected $900,000. That money came in, $900,000. Inventory, they had $10,000 in inventory. So remember, they purchased for $400,000. So if in inventory they have $10,000, that means they sold for $390,000. Had sales on account 1 million, inventory purchases on account which would be considered expense. Which would be considered expense, inventory expense. And other expenses of $200,000 at the end of the year. And $50,000 and inventory related accounts payable. This is kind of tricky here. There's a lot of trick inside of this. I don't want to waste time on this. I don't want to waste time on this. So let's go back to this. In the question, okay. The question says that sales on account $1 million, translation revenue recorded $1 million, not all cash collected yet. Then it says accounts receivable $100,000 at year end, meaning customers still owe 1 million minus $100,000, 900,000. What? Wait. Cash collected. Okay, cash collected $900,000. Okay, that's good. Cash collected $900,000, and we said that. It also says inventory purchases on account of $400,000. Translation: inventory bought on credit, not all cash paid yet. Not all cash paid yet. Then inventory related accounts payable, $50,000, meaning they still owe suppliers $50,000. Cash paid $350,000. Makes sense. CPA trigger words. Phrase said sold on account, meaning credit sale. Credit sale, meaning accounts receivable goes up. Purchased on account, credit purchase. But on account, accounts payable goes up. What do you mean? Purchased on account, credit purchase. Yes, if you purchase on account, your account payable goes up, okay. Collected from customers, cash received. Paid suppliers, cash paid. Whenever you see on account, immediately think no cash moved today. Someone owes somebody money. Okay? I understand that. But let's continue resolving this question. Let's solve it slowly using your cash. What basis are we reporting? The question says a company reports on a cash basis. Okay, on cash basis, and asks what is the company's cash basis income. So our destination is cash basis income. Step 2, start with revenue. The question says 1 million. That is accrual revenue. Why? Because on account means customers have not necessarily paid yet. Adjust for accounts receivable. Year-end accounts receivable 100,000. This is the first year of business, so beginning accounts receivable is 0. That means $900,000 cash collected from customers. Okay, cash revenue $900,000. Adjust purchases. The question says inventory purchased on account $400,000. Again, that's accrual information. Not all of it has been paid. Adjust for accounts payable. Year-end inventory related accounts payable $50,000. $50,000 at year-end. Let me see where it says that. It says that $50,000 respectively had accounts receivable, inventory, and inventory related accounts payable of $50,000. Okay, inventory related accounts payable $50,000. Okay, so $400,000 minus $50,000 is $350,000. So cash paid to suppliers $350,000. Step 4. What about inventory? The company has ending inventory of $10,000. This is where many students get trapped. Under accrual accounting, you would calculate cost of goods sold equals purchases minus ending inventory. But the question says company reports on the cash basis. Under cash basis, inventory purchases are expected when paid. So we use the cash paid amount, $350,000. The ending inventory balance is a distractor. I see. Step 5, other expenses. The question says, other expenses, $200,000. No payable or prepaid information is given. Assume all paid. So $200,000, cash expense. Step 6, compute cash basis income. Income $900,000, less cash paid for inventory $350,000, less other expense $200,000, so $550,000. $900,000 minus $350,000 minus $250,000 equals $350,000. All right, so it's $350,000 gain. $350,000 gain. Okay, so here's this is just the language that we needed to understand in this question. Okay. At the end of the year, the company had accounts receivable, inventory, and inventory-related accounts payable of $100,000, $10,000, and $50,000 respectively. That inventory thing here, the $10,000, is to distract you. And that really just distracted me. It was a trick. It was a trick. Trying to trick you. Okay. All right. Makes sense. Makes sense. We have a lot more questions. 33. All right, we're not too far. James Lee, MD, keeps his accounting records on cash basis. During year 2, Dr. Lee collected $100,000 in fees from his patients. That's cash came in. At December 31st, year 1, Dr. Lee had accounts receivable of $20,000. So that's money they have to pay him. At December 31st, year 2, Dr. Lee had accounts receivable of $30,000. So there's an increase of $10,000 from year 1 to year 2. And unearned fees of $1,000. So that's money they paid him, but he has not provided the service yet. On an accrual basis, how much was Dr. Lee's patient service revenue for year 2? So here they started with year 1, right? Let me see. During year 2, During year 2, Dr. Lee collected $100,000 in fees from his patients. So we got $100,000 that came in, cash collected. That's good. So during year 2, Lee collected $100,000 in fees from his patient. Okay, if that here, it's collected during year 2. James Lee keeps his accounting on cash basis. Cash basis. During year 2, he collected $100,000 cash. At December 31st, year 1, you see? December 31st, year 1, Lee had accounts receivable of $20,000. So from that $100,000, there is a $20,000 that belongs to year 1, to services provided in year 1. So we will only account for activities happen in year 2, $80,000. $80,000. At December 31st, year 2, Dr. Lee had accounts receivable of $30,000. Accounts receivable of $30,000. He has already collected $80,000 of money of this year, and he has accounts receivable of $30,000. That's $120,000 total money that activities that he does in year 2. For cash, it would be different, but for accrual, we only care about activities happen in year 2. So $120,000 of activities in year 2 and unearned fees of $1,000. Unearned fees, that means it's money you received, Dr. Lee, but you have not provided the service for that money yet. So from the $120,000, we need to deduct or subtract $1,000. So it's going to be $119,000. $119,000. And I think we're not there yet. I'm thinking it's not right. But that's not a hard thing. All right, so here's what it says. Let me think through this now. It says that James Lee, MD, keeps his accounting records on cash basis. During year 2, Dr. Lee collected $100,000. Okay? That's money collected in year 2. But it doesn't mean that all that money was earned in year 2. Okay? Collected $100,000 in year 2. December 31st, year 1. Now, we are talking about activities happen in year 1. Dr. Lee had accounts receivable of $20,000. So that means in year 1, customers owed $20,000 to Dr. Lee. That money he was supposed to collect in year 1 that he did not collect in year 1 that are transferred to year 2. So now, all right, $20,000, but he collected $100,000. He collected $100,000. Okay, leave that here. Let's say that we put this all together, it's $120,000. Wait. Okay. At December 31st, year 2, Lee had accounts receivable of $30,000. So that money, this is money customers still owe Dr. Lee. $30,000. There's an increase. Lee account receivable of $10,000 in accounts receivable. I see. Okay. Accounts receivable. But accounts receivable under accrual, under cash, you do not report that, but under accrual, you report accounts receivable. You collected $100,000 in year 1. In year 2. From that $100,000, $20,000 belong to year 1. So $80,000. Okay. Accounts receivable of $30,000. So that would make it, I said 80,000. So that's going to be 110,000. Okay, 80,000 was plus 30,000 is 110. minus 1,000, so 109. That's, yeah, I think I was mistaken something. Yes, that wouldn't be so hard. That's correct. It's $109,000. Okay, makes sense. That makes sense. Yes, yes, yes. Okay, mon ami. A consulting company reports on the cash basis. Okay, during the company's first year of business, it collected $100,000. So cash came in, $100,000 in fee from clients. At the end of the year, the company had accounts receivable of $40,000. So that's money they still owe them. And unearned revenue of $15,000, that's money they received but they have not provided the service for. What is the company's accrual basis service revenue for its first year of operations? That should be simple, not too hard, not too complicated. So, first year, it collected $100,000. So you collected $100,000 in fees from clients. That cash you received. Accrual basis service revenue. So we're talking about accrual, not cash, okay? But you received the cash, that's right. So that's consulting company reports during the company's first year of business. So we don't have any previous year thing. So that $100,000 was earned. It was earned, accrued and earned in first year, okay? At the end of the year, the company had accounts receivable of $40,000. So that means transactions that happen in the year accounts for $140,000 so far. And unearned revenue of $15,000. So that money you received that you have not provided the service for, under accrual you cannot report that $15,000, but you can report the $40,000. So we're gonna do 140,000 minus 15,000. 140,000 minus 15,000. Okay. 140 minus 15. So that's $125,000 of business that happens in the year. That's correct. See, we're getting it. Each of the following titles is appropriate for financial statements prepared on the modified cash basis of accounting except. Each of the following titles is appropriate for financial statements prepared on the modified cash basis of accounting. This we're not going to waste time with it because this is a lesson we need to memorize. Lesson that has to be memorized, my friend. Now let's see what it is. Let us see. This is a vocabulary question. Yes, vocabulary question. The question asks each of the following titles is appropriate for financial statements prepared on a modified cash basis except. So we are looking for the one title that does not belong. Okay, what is modified cash basis? Modified cash basis is mostly cash basis but with a few accrual concept added. For example, depreciation may be recorded, fixed asset may be shown, long-term debt may be shown, but it is not GAAP accrual accounting. Analyze the choices. Balance sheet modified cash basis, appropriate. The title clearly tells the reader this is a balance sheet prepared using modified cash basis accounting. No problem. Statement of assets and liabilities arising from cash transactions. Appropriate. This is a common cash basis type title. It avoids using traditional GAAP terminology. Statement of revenues collected and expensed. Paid. Appropriate. This is a classic cash basis language. Notice the keyword. Revenues collected, expenses paid. Those are cash basis words. Statement of comprehensive income, not appropriate. This is the answer. Why? Because comprehensive income is a GAAP accrual accounting concept. Comprehensive income includes net income plus other comprehensive income. Example of other comprehensive income: foreign currency translation adjustments, certain pension adjustments, certain unrealized gains, losses. Those concepts do not belong in cash basis or modified cash basis financial statements. CPA shortcut. When you see comprehensive income, immediately think GAAP accrual accounting, not cash basis, modified cash basis, tax basis. Memory trick. Cash basis words: collected, received, paid, cash transactions. GAAP words: comprehensive income, other comprehensive income, earnings per share, accrued revenue, accrued expense. Okay, so the answer is statement of comprehensive income. Read it again. Each of the following titles is appropriate for financial statements prepared on a modified cash basis of accounting except what? A statement of comprehensive income. Okay, statement. Right, we have balance sheet. This is modified cash basis. Statement of asset and liabilities arising from cash transaction. That's cash. Statement of revenues collected and expensed paid. Okay, let's go. Which of the following statements is, if any, concerning the modified cash basis of accounting is or are correct? The modified cash basis of accounting employs some elements of accrual accounting. Yes. To be acceptable, modifications to the cash basis of accounting must have substantial support in practice. I don't know the second one. Let's see. Let us see. Didn't come here to play, my friend. Okay. This one is testing your understanding of modified cash basis. Let's analyze each statement. The modified cash basis of accounting employs some elements of accrual accounting. Ask yourself, what is modified cash basis? It's cash basis plus a few accrual concepts. Example: depreciation, fixed asset, long-term debt. So this statement is correct. Statement 2, to be acceptable, modifications to the cash basis of accounting must have substantial support in practice. This means you cannot just invent your own accounting method. The modification must be commonly accepted. For example, recording depreciation, recording fixed assets, recording long-term debt. Those are accepted modifications. But randomly recording some receivables and not others, making up your own revenue rules, would not be acceptable. So statement 2 is also true. Okay, that's what we wanted to know. Teacher-student version. Teacher, is modified cash basis pure cash basis? No. Teacher, does it use some accrual concepts? Student, yes. Therefore, statement I What do you mean, teacher? Therefore, statement I. What do you mean? True. Can a company invent any modification it wants? No. What must modifications have? Substantial support in practice. Therefore, statement 2 is true. Okay, therefore statement 1 is true, statement 2 is true. Okay, I understand. Memory rule, modified cash basis plus accepted accrual elements. The two keywords to remember are some accrual elements, substantial support in practice. Okay? Some accrual elements, substantial support in practice. Remember that. Both 1 and 2. In some tax bases, financial statements differ from those prepared under GAAP in that income tax basis financial statements. Income tax basis financial statements differ from those prepared under GAAP in that income tax basis financial statements. Income tax basis financial statements differ from those prepared under GAAP in that income tax basis financial statements. Ooh. Teach me the English, please. Teach me the English. Teach me the English. Teach me that English. Ooh. Dear, shaking your brain. Okay, well, we are getting it. We are getting it, my friend. Okay. Okay. Let me see. All right, so what does it say? This question is testing the difference between income tax basis accounting versus GAAP accounting. The question asks, income tax basis financial statements differ from GAAP in that income tax basis financial statements. Let's go. I don't get. All right. Before we go to the answers, let's understand the question. So help me understand what the question is really asking. Before looking at the answers, let's do what you've been practicing. Interpret questions phrase by phrase. Phrase 1, income tax basis financial statements. Stop here. This means the financial statements are prepared using tax rules, not GAAP rules. Okay? Income tax basis financial statements using tax rules. Think IRS rules, tax return rules, tax accounting. The company is asking, if I prepare my financial statements the same way I prepare my tax return, what would be different? Phrase 2, differ from those prepared under GAAP. Now we are comparing two words. Word 1, tax basis, prepared according to tax law. Prepared according to tax law. Word 2, GAAP, prepared according to accounting rules. The question is asking, what is one important difference between these two words? Phrase 3, in that. This simply means because, or specifically because. So the question becomes, tax basis financial statements differ from GAAP financial statements because. Okay. What is the question really asking? Which answer is true? But what is the fundamental difference between tax accounting and GAAP accounting? Okay. Financial statements. In that become tax basis financial statements. Income tax basis financial statements differ from those prepared under GAAP. In that income tax basis financial statement do not contain disclosure about capital and operating lease transaction, do not include non-taxable revenues, non-deductible expense determining, include detail. All right, let's go to the answer, my friend. Let's go to the answer. Okay, the big CPA idea. When you hear tax basis, think, what does the IRS allow? When you hear GAAP, think, what gives the most accurate economic picture? Many times, both systems record the same transaction. The difference is when they record it. Example, depreciation. A truck cost $100,000. GAAP may depreciate evenly year 1, year 2, year 3. Tax may allow accelerated depreciation. Year 1, 50,000. Year 2, 30,000. Year 3, 20,000. Same truck, same total expense, different timing. Example, warranty expense under GAAP. So, may depreciate it under GAAP is year 1, 20,000, year 2, 20,000, year 3, 20,000. Under tax, year 1, 50,000, year 2, 30,000, year 3, 20,000. Okay. Same total expense, different timing. Example, warranty expense, GAAP, estimate warranty expense today. Tax, deduct warranty expense when actually paid. Same expense, different timing. The hidden question the CPA exam is really asking, what is the most common way tax accounting differs from GAAP accounting? And before seeing the answers, the experienced CPA candidate already thinks revenue and expenses are often recognized in different periods. That's the core idea behind tax basis accounting. Your exam translation, when you see income tax basis, financial statements. When you see income tax basis financial statements differ from GAAP, translate it mentally into what does tax accounting do differently from GAAP accounting. Okay? And your first thought should be timing difference in recognizing revenue and expenses. Okay, so let's see which one has timing. Do not contain disclosure about capital and operating lease transactions. That doesn't have anything about timing. Do not include non-taxable revenues and non-deductible expenses in determining income. Includes detailed information about current and deferred income tax liabilities. Recognize certain revenues and expenses in different reporting periods. This is the right one. Oh, yeah. This is the right one. In different periods. So timing. Okay? When you see a question like this, making a difference between what? A difference between a tax basis and GAAP. Okay? It's timing. Period, timing, whatever is in relation to that. We are getting there, my friend. We are getting there. When a CPA is preparing a financial statements under a special purpose framework, it is important for the CPA to remember that. What? To remember what? GAAP financial statements title should be used. The basis of accounting should be easily identifiable. The basis of accounting should be easily identifiable. I would say that too. The financial statements must still conform with GAAP. That's correct too. The financial statement's title must be modified. What? The financial statements must still conform with GAAP. That's right. The basis of accounting should be easily identifiable. I would say that too, but that's more heavy. The financial statements must still conform with GAAP. So you cannot be in conformity with anything else. And this is incorrect. The basis of accounting should be easily identifiable. This one you should have taken. What? General purpose. General purpose framework. Examples: generally accepted accounting principles, international financial reporting statement standards, IFRS, statements of federal financial accounting standard, SFF, statements of governmental standards. General purpose. This is general purpose framework. General purpose framework. Okay, example: generally accepted accounting principles, which is GAAP, international financial reporting standards, which is IFRS, statements of federal financial accounting standards, this is SFF, whatever, statements of governmental standards. All right, this is general purpose framework. Special purpose framework, non-GAAP. All right, in this one we have cash accounting basis, tax accounting basis, regulatory agency accounting basis, contractual accounting basis. This is a special purpose framework. The question says, when a CPA is preparing the financial statements under a special purpose framework, it is important for the CPA to remember that the basis of accounting should be easily identifiable. Okay, easily identifiable. All right. Special purpose frameworks are reporting frameworks for accounting basis other than generally accepted accounting principles, which is GAAP, or the International Financial Reporting Standards, IFRS. Special purpose frameworks are often used by non-public business entities as the application of GAAP, which is required of public business entities, can be time-consuming and costly. All right, so let's stay right there. Stay right there. So when a CPA is preparing the financial statements under special purpose framework, it is important for the CPA to remember that the basis of accounting should be easily identifiable. All right, so we have the special purpose framework. We have the general purpose framework. Okay, general purpose framework, which is the GAAP, the IFRS, the statements of federal financial accounting standards, the statement of government standards. This is general purpose framework. The second one, special purpose framework, non-GAAP. Special purpose framework. This is non-GAAP, okay? Where we have the cash accounting basis, the tax accounting basis, regulatory agency accounting basis, contractual accounting basis, okay? So remember that. Henco prepared financial statements on the cash basis of accounting. Cash basis of accounting. The cash basis was modified so that an accrual of income taxes was reported. Are these financial statements in accordance with the modified cash basis of accounting? Hancock prepared financial statements on a cash basis of accounting. Cash basis of accounting. The cash basis was modified so that an accrual of income taxes was reported. Yes. Are these financial statements in accordance with the modified cash basis of accounting? Yes. No, because it's illogical. No, because there is no substantial support for recording income taxes. No, because the modification result in financial statements equivalent to those prepared under the accrual basis of accounting. I'm going to say yes, but let me confirm. What is our time? What is our time? What is our time? It's 14 minutes. We need to finish these few questions. Burn on the upbeat music. Alright, let's interpret the question first before looking at the answers. Hancock prepared financial statements on the cash basis of accounting. Alright, translation, the company is using cash basis accounting. Under cash basis, alright, remember, under cash basis, revenue when cash is received, expense when cash is paid. Okay? Revenue when cash is received. No accruals, no receivables, no payables, no accrued taxes. Phase 2, the cash basis was modified. There is a modification. This is a huge clue. The question is no longer talking about pure cash basis. Now we're talking about modified cash basis, all right? Think cash basis plus some accrual concepts. Examples that are commonly allowed: depreciation, fixed asset, long-term debt. Phrase 2, so that an accrual of income taxes was reported. This is the key phrase. Let's translate. What is an accrual of income taxes? It means income tax expense is recorded before cash is paid. Income tax expense is recorded before. Example, current year's tax, $50,000. Paid so far, $30,000. Still owe $20,000. Under accrual accounting, income tax expense is $50,000. Cash 30, income tax payable $20,000. Notice what happened. We created a payable. We used accrual accounting. Phrase 4. Are these financial statements in accordance with the modified cash basis of accounting? This is the real question. CPA exam is asking, is this an acceptable modification of cash basis, or did they go too far? What is the exam testing? Remember the rule from the previous question. Modified cash basis may use some accrual concepts if they have substantial support in practice. All right? If they have substantial support in practice and do not effectively become full accrual accounting. The question is testing whether accruing income taxes is one of those acceptable modification. The hidden question the exam is really asking: can a cash basis company record income taxes on an accrual basis and still call itself modified cash basis? That's the issue. Not taxes, not tax expense, not tax payable. The issue is this modification acceptable under modified cash basis accounting? That's what you should be thinking before reading ABCD. Exam translation. When you see cash basis was modified so that an accrual of income taxes was reported, translated into they started with cash basis, then added one accrual feature, income tax accrual. Is that allowed under modified cash basis? Now you're ready to evaluate answer. All right, so let's go. Well, I still don't know. What are the things that are allowed? We're gonna. What is allowed? Depreciation, fixed asset, long-term debt. Example, but tax is not part of it. Tax is not part of it. No, because the modification is illogical. No, because there is no substantial support for recording income taxes. That's what I would say then. There is no substantial support to record for recording income taxes. So would the answer be there is no there is no substantial support for recording income taxes? Let's see what you say now. Tell me now. Tell me now. Yes, and that's exactly the trap the CPA exam wants you to think about. Let's test the logic. The question asks, is accruing income tax an acceptable modification of cash basis accounting? You might think no, because income taxes are an accrue item and there is no substantial support for recording them. That would lead you to choose C. But here is the problem. There is substantial support for accruing income taxes. Income tax accruals are common and well understood in accounting practice. So the issue is not that income taxes lack support. Therefore, C is wrong. The real issue is deeper. Modified cash basis allows some accrual concept, but it cannot be modified so much that it becomes essentially accrual accounting. Okay? It cannot be modified so that, income taxes are tied to income determination. Once you start accruing income taxes, you're moving toward accrual basis financial statements. That's why the correct answer is no, because the modification result in financial statements equivalent to those prepared under the accrual basis of accounting. So how do you explain how do you explain D? Because so what makes us think that because the modification result in financial statements equivalent? What makes it equivalent? All right, the wording of D is what makes this question confusing. It's slowed in. The question says the cash basis was modified so that an accrual of income taxes was reported. You're asking why would just accruing income taxes make the statement equivalent to accrual accounting? The answer is it doesn't by itself. That's why many students struggle with this question. What the CPA exam is really teaching under OCBOA are the comprehensive basis of accounting. Modified cash basis can include fixed asset, depreciation, long-term debt, but one modification is specifically prohibited: recording income taxes on the accrual basis. Why? Because income tax accrual accounting is tied directly to measuring income under accrual accounting. Think of it this way. Imagine we have cash basis, revenue equals when cash comes in, expense when cash goes out. Now suppose we say let's accrue income taxes. To accrue income taxes, you first need to determine what is taxable income for the year. And to determine the proper tax liability, you start moving toward matching revenues and expenses to the proper periods. That is an accrual concept. You do not need to prove that the statements literally become accrual basis statement. The exam rule, modified cash basis may not include an accrual for income taxes. That's the law. Okay, that's the rule. That's why you should have told me. Modified cash basis may not include an accrual for income taxes. Okay. Why not? So, accrual income taxes moves the statements too close to accrual accounting. Okay, that's why. Okay. This is wrong. It's a yes. It is a yes. Listen to me. You have gotten the wrong answer. The answer is yes, and we spend a lot of time thinking about D is the right one. Oh. The answer is A. That means our entire reasoning toward D was wrong. Why the answer is yes. The question says prepared financial statement on the cash basis. Cash basis was modified so that an accrual of income taxes was reported. Then asked, are these financial statements in accordance with the modified cash basis? Yes. Wait, what does this teach us? I was treating the income tax accrual as if it was automatically transformed the statements into accrual accounting, but modified cash basis is much more flexible than that. Remember the rule from previous questions. Modified cash basis plus some plus selected accrual elements. All right, so that's what I was gonna select for myself, but okay, that's cool. We learned the lesson. I have things to remember. Will not result in financial statements equivalent to those prepared. Yeah. So, under a strict cash basis of accounting, revenues and expenses are recorded only when cash is received or paid. Under a modified cash basis of accounting, certain accruals and or deferrals are recorded for financial statements purposes. The most common modifications are the capitalization and amortization of long-lived assets and the accrual for income taxes, recognition of income tax expense and related liability. Remember that part right there. Okay? The recognition of income tax expense and the related liability are logical modifications. They are logical modifications. The accrual of income taxes is common under modified cash basis accounting. Okay? It is common under modified cash basis accounting. Modification of income tax alone will not result in financial statements equivalent to those prepared under accrual basis accounting. Only if all transactions in accounts are converted to the accrual basis would the statements be equivalent. But only tax, you only modify tax, that doesn't make it equivalent. Okay. Let's go. We learned a lesson. Oh. who's watching with me? I mean, I see someone is watching, but I don't know who is that. If you're there, leave me a message or a comment somewhere so I can recognize you, so I can acknowledge you, you know? Oh, it's already time. It's already time. Yeah, if you're someone who's watching here or studying with me, let me know. Are you on TikTok? Are you on Facebook? Or on YouTube? Right? There is someone here with me, but I cannot tell who this is and where they're watching from. So just let me know. Leave me a comment somewhere. Alright, leave me a comment somewhere so that I know you're here. And I know your name so we can acknowledge your presence. Alright, let's go on break. We'll come back and finish these few more questions we have left.
With the great memory, oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. passed every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too.
All right, let's go back to work. Let's go back to work so we can complete these few questions that we have left. It's not gonna take us 1 hour to complete them. So we have 30. We have like 1, 2, 3, 4, 5, 6 more questions. 6 more questions to do. I feel I'm getting it. I feel I'm understanding the concept. Put my hand behind my back like this to support it. I think I'm understanding the concept so far. Yeah. All right, so let me see. All right, Yuko had cash payments and accounts on accounts during the current year totaling $455,000. Use beginning and ending accounts payable balances for the year were $64,000 and $50,000 respectively. What amount represents use accrual basis purchases for the year? Okay, so let's see what they're asking. All right, so we have Yuko had cash payments on account during the current year totaling $455,000. Use beginning and ending accounts payable balances for the year were $64,000 and $50,000 respectively. So beginning payable was $64,000, ending payable is $50,000. So there is a difference of what? Of $14,000, right? $14,000 respectively. What amount represents a use accrual basis purchases for the year? Cash payments had cash payments on account during the current year. Cash payments. Cash payments of what? Of $455,000. But from this $455,000 cash payment, there is a beginning balance of $64,000 that there is a payable balance, beginning payable balance of $64,000. Yeah, $64,000. Use accrual basis purchase. Minus 64,000. I'm gonna do this. 455,000. Let me see something. Because the $64,000 is beginning, so it did not happen in this current year. $455,000 minus 64,000. 390 something, but that's not it. All right, let me get it. I think I'm getting tired. Why are you getting tired, man? It's just 2 hours. Only did 2 hours. Let's interpret questions first before. Yuko had cash payment on account during the current year totaling $455,000. The keywords are cash payments. That means actual cash paid on account. That means paying suppliers for purchases made on credit. So the $455,000 in cash paid toward accounts payable. This is a cash basis number. This is a cash basis number. Phrase 2. Beginning and ending accounts payable balances were $64,000 and $50,000. Let's translate. Beginning accounts payable $64,000. That money you had to pay. Ending accounts payable $50,000. Accounts payable decreased by $14,000. What does the decrease in accounts payable mean? It means we paid off more debt than we created. In other words, cash payments exceeded purchases. Okay. So a decrease in accounts payable. If it decreased accounts payable, that means money that I owed, I pay now. Okay, $14,000. I owe that money in the past, I pay it now. It decreases accounts payable. I owe the money in the past, but I pay it now. It decreases accounts payable. When accounts payable decreases, Should we report that under accrual? No. This is minus $14,000. 455 minus 14. Because cash has already reported that $14,000, but we're not supposed to report that $14,000 as an expense. But had cash payments on accounts to the, okay, so that's payment, that's expense. We need to add, no, we need to reduce that $14,000 from payment that you made. 455 minus 14, 441. I would say it's 441. That's correct. Yeah, that's correct. Okay. Financial statements prepared using the income tax basis of accounting should. Using the income Let's see, financial statements prepared using the income tax basis of accounting should provide a reconciliation of accrual basis income to tax basis income. Recognize revenue when earned, regardless of when cash is received. No. That's the opposite. Report long-term assets at their fair value. Use the direct write-off method to record credit losses. Okay, let me see. I don't know which one it is yet. Let's do what you've been practicing. Financial statements prepared using the income tax basis of accounting. The question is talking about the tax basis financial statements, not GAAP, not cash basis, but tax basis, not modified cash basis. Think if I prepare my financial statements using IRS tax rules, what would they look like? Okay, phrase 2, should. This means which of the following is a characteristic of tax basis accounting? Yeah. So which one? Provide a reconciliation of accrual basis income to tax basis income. Recognize revenue when earned, regardless of when cash. This is under accrual. Report long-term assets at their fair value. I would say, well, long-term asset, fair value, market value. That could be right. Okay, man. What do I know about tax accounting? The big ideas are revenue and expenses may be recognized at different times than GAAP. Tax accounting follows tax law. Tax accounting often uses different depreciation methods. Tax accounting does not use some GAAP concepts, such as allowance for bad debts. Provide reconciliation of accrual basis of accounting basis income. This sounds reasonable, but ask, is a reconciliation required every time? No. Okay, tax basis. Financial statements do not automatically require a reconciliation to accrue income. Not the best answer. Recognize revenue when earned. regardless of when cash is received. What accounting basis is that? That's the definition of accrual accounting, not tax basis. This is wrong. Yeah. Report long-term assets at their fair value. What accounting basis is that? Sounds like GAAP or valuation accounting. Tax basis generally carries assets using tax rules and tax basis amounts, not fair value tax rules. Okay. Use the direct write-off method to record credit losses. Now think about taxes. For bad debts, GAAP uses allowance method, estimate bad debts before they happen. Tax accounting uses direct write-off method. Wait until a specific account becomes uncollectible, then write it off. Okay. Direct write-off. Oof. Yeah. Okay. The modified cash basis of accounting is a basis of accounting that presents financial statements in accordance with what? The modified cash basis accounting, general accepted accounting principle, GAAP, no. A special purpose framework, the governmental accounting, the international, no. It's a special purpose framework. Modified, yeah, that's a special purpose framework. The modified cash basis of accounting is a basis of accounting that presents financial statements in accordance with a special purpose framework. Yes. Which of the following is not an other comprehensive basis of accounting? Which of the following is not an other comprehensive basis of accounting? Pure cash, other comprehensive basis, other comprehensive income, other comprehensive, pure cash basis, modified cash basis, pure accrual, income tax basis. Well, I would say income tax basis. Let me see. Let me understand what they are asking. Hallelujah. That's a really good study session. Really good study session. This is a definition. This is the definition question. Let's interpret it before looking at the answers. Which of the following is not? The question is asking which choice does not belong in the group. 3 belong, 1 does not. Phrase 2, other comprehensive basis of accounting. This is the key phrase. The CPA exam often calls this OCBOA, other comprehensive basis of accounting. Other comprehensive basis of accounting. Think accounting methods that are not GAAP but are still acceptable. The OCBOA, other comprehensive basis of accounting, family. The CPA wants you to memorize these members. Cash basis is OCBOA, modified cash basis, income tax basis. These are all alternatives to GAAP. Okay? Cash basis, modified cash basis, modified cash basis, income tax basis. Okay. So what about pure accrual basis? Here's the trick. Pure accrual basis is basically GAAP's measurement foundation. It's not an other basis. It is the normal accounting basis used by GAAP. Therefore, it is not an OCBOA. Okay. Pure cash basis. Modified cash basis, pure accrual. No. Pure, which one? Pure accrual basis, that's right, is a GAAP one. Pure accrual basis is GAAP. That's correct. All right, in financial statements prepared on the income tax basis, how should the non-deductible portion of expenses such as meals and entertainment be reported? In financial statements prepared on the income tax basis, included in the expense category in the determination of income, included in a separate category in the determination, excluded from the determination of income but included in the determination of retained earnings, excluded from financial statements. So, included in the tax and the expense category in the determination of income. Yes, so expense such as meals, entertainment, include part of it will be included in expense. In financial statements prepared on the income tax basis, we're in the world of tax basis accounting. Not GAAP, not cash basis, not modified cash basis. The rule is financial statements follow tax rules. How should the non-deductible portion of expenses, keyword non-deductible, non-deductible, so you cannot report non-deductible. This means the IRS says you spent the money, but we're not letting you deduct it all. Deduct all of it. The expense is real. The deduction is limited. Such as meal and entertainment. Classic tax example. Suppose business meal is $100. IRS allows 50% of it. So, 50% is non-deductible. What is the question really asking? CPA exam is asking if an expense is real, but the IRS doesn't allow a deduction, they will still show the expense on tax basis financial statements. Included in the expense category in the determination of income. Included in the expense category in the determination of income. That's correct. Yes. Yeah. If a company uses the modified cash basis of accounting, the modification from the pure cash basis should have substantial support. In this context, substantial support requires the financial statements have only minor modification from GAAP. The modification must be the same as those required by tax law. The modification must be the same as GAAP and not illogical. No modification are allowed. No. If a company uses the modified cash basis of accounting, the modification from the pure cash basis should have substantial support. Yes, in this context, substantial support requires the financial statements have only minor modification from GAAP. The modification must be the same as those required by tax law. The modification must be the same as GAAP and not illogical. Let me see. Yeah, it cannot be illogical. But should it be the same? We are getting there, my friend. We are getting there. If a company uses the modified cash basis accounting, we are in the world of modified cash basis. Remember, modified cash basis plus some accepted accrual concepts. Example, depreciation, fixed assets, long-term debt, sometimes accrued income taxes. Accrued income taxes. Phrase 2. The modification from the pure cash basis should have substantial support. This is the key phrase. The question is asking, what does substantial support mean? Not what modification are allowed, but yes, what makes a modification acceptable. What does substantial support mean? Think. The company cannot invent accounting rules. For example, acceptable, recording depreciation, recording fixed asset, recording long-term liabilities. These are widely used and supported in practice. Not acceptable, recording only some receivables, creating random revenue rules, mixing methods with no logic. They lack support. Analyze the choices. No modification allowed. That's not right. Modified cash basis literally means cash basis with modification. The modification must be the same as those required by tax law. That's wrong. That's describing tax basis accounting, not modified cash basis. The modification must be the same as GAAP and not illogical. This is wrong. In the modification, if the modification had to be the same as GAAP, then we'd simply have GAAP financial statements. Modified cash basis is not GAAP. The financial statements have only minor modification from GAAP. This one is worded awkwardly, but is the best answer available. The idea, the modifications are recognized, commonly accepted, and do not radically transform the statement. That's what substantial support is getting at. Okay. Oh, no way. That's incorrect. The modification must be the same as GAAP and not illogical. This is the right answer. The modification must be the same as GAAP and not illogical. And we are done. All right, everybody. Thank you very much for spending time with us today. It has been a great study session. And we will end the live right now, even though we still have 45 minutes left. But it's time. We're done with what we were supposed to do today. Thank you very much for spending time with us and have a great day. Hey, if you're watching, let me know you're here. Like, leave a comment, right? Leave a comment. I see I have like 1 or 2 people here on YouTube. I have some people somewhere else. Just leave a comment. Quittez un commentaire. Deja un comentario. I don't know what language you speak. But just go ahead and leave a comment so I know you were here. All right? Or like the video or something like that. All right. Thank you very much. Have a great day.
Come study with me.